Hello, everyone, and thank you for joining us today. My name is Aura Wexler, and I'm a partner and the head of the Dentons Toronto office corporate, as well as securities groups. I'm very pleased to be your moderator for this session on transactional activism in Canada, which we hope you will find both interesting and informative. For now, I'm going to pass it over to our speakers to introduce themselves. Jessica, can you start us off?
Thanks, Aura. By way of introduction, my name is Jessica Myers, and I'm a partner in Dentons Corporate Group, practicing out of Calgary. A large part of my practice involves advising public companies, primarily in the power and energy sectors, on capital markets and M&A transactions, including hostile and contested M&A. In addition to transactional advice, I also regularly advise clients on day-to-day corporate governance, public company disclosure, and securities regulatory matters.
Hi, everyone. Tom Rudikoff. I'm a U.S. lawyer, and my practice focuses primarily on public and private U.S. and cross-border M&A and capital markets transactions.
Thanks. I'm Jason Saltzman. I'm a partner in the corporate and securities group as well. I'm the national co-head of our M&A group, and I've worked on a number of contested M&A deals, from hostile takeovers to proxy contests trying to replace boards, to proxy contests and that are more transaction related, including I'll refer to a few times, a recently completed $1.8 billion acquisition of Magnet Forensics by Thoma Brava, which was contested by one of its larger shareholders.
Good afternoon. I'm Bill Zawada. I'm Vice President of Business Development with Laurel Hill Advisory Group. My role is focused on sales, relationship management, and strategy development for our clients in Eastern Canada. Just a brief word about Laurel Hill, for those who may not be familiar. We are a leading shareholder communications and advisory firm. We provide a range of shareholder communications advisory, governance and compensation advisory, proxy solicitation information, and other services. And our work really spans, routine and contested shareholder meetings, hostile bids, and other, corporate matters that require shareholders to vote or to take some other action.
Thanks, Bill. We can proceed with the next item on the agenda, which is the real substance of our presentation. And Bill, I think I'll keep it with you. Can you tell us a little bit about what we mean by transactional activism, and perhaps give us some examples?
Yeah, absolutely. So, transactional activism is broadly two things. First, it's shareholders publicly opposing board-approved M&A transactions, such as plans of arrangement. That require shareholder approval. Second, it's shareholders publicly demanding certain things, certainly, strategic reviews, demanding to sell assets, to undertake buybacks, increase dividends, improve corporate governance, et cetera. And of course, those transactional demands can sometimes cross over into board level activism when they're not properly addressed. So this is definitely on the rise here in Canada, and we're seeing that activists are having more and more success. So in 2021, for example, transactional activism resulted in a record number of M&A deals either being defeated or renegotiated at a higher price. So, for example, at Expo, Great Canadian Gaming, Rocky Mountain, Dorel Industries, FanCamp Exploration, SIR Royalty Income Fund, and Viva Gold. That year we also saw TCI Fund Management, call on CN Rail to abandon its pursuit of Kansas City Southern unless a key deal condition was dropped. In 2022, we saw opposition to two of the biggest mining deals in Canada, namely Turquoise Hills deal to be acquired by Rio Tinto and Yamana Gold's deal to be acquired by Goldfields. This year alone, we've seen, Noranda income funds go private, opposed, ultimately resulting in a 39% bump in the deal price. We saw the Ritchie Brothers and the Magnet Forensics deals publicly opposed, ultimately approved by shareholders. But really the headline case, I would say, this year has been the Glencore Teck Resources transaction or battle over Tech's proposed spinoff. Tech was ultimately forced to withdraw the proposal at the 11th hour when it was clear that the deal vote would be defeated. And really, just the last few weeks, we've seen Ancora publicly call on Algonquin Power to sell off assets. In fact, Starboard had reportedly also done that privately. We've also seen a shareholder come out against the Absolute Software plan of arrangement.
Thanks, Bill. Certainly many of these have received a lot of media attention. In your response, you referenced record numbers. So what do you see as some of the key drivers for transactional activism?
Yeah, I think there's definitely a few things. I would say, first, and this is not really new, but, public statements and vote against campaigns can be fairly low cost. Certainly, it doesn't cost much to put out a press release to say you don't like a deal, or to say that, to call on the company to do something. And of course, if you're going to solicit votes against the deal, you can utilize the public broadcast solicitation exemption and call on shareholders to vote against using the management proxy. But secondly, and I would say this is probably more relevant in terms of some of the recent uptick, is the volatility and uncertainty that we're seeing in the market. Shareholders are looking for ways to improve returns, and so they're really going to leave no stone unturned. And look for ways to increase returns. Challenge you if you think your deals cut corners, or undervalues you, or if they want you to do something, or do something faster than you've committed to doing. Thirdly, and I would say also market driven, is the high cost of capital right now. As a company, I think if you're struggling, and in need of financing, you can undertake a dilutive equity financing. You can undertake additional debt at a higher cost. Alternatively, you can look at selling assets or selling the company. So I think companies are facing some tough choices, and I think there is some element of panic selling and probably some bad deals getting done. And as per my second point, shareholders are paying attention.
Thanks, Bill. And I really don't mean to pick on you, but your response triggers many thoughts in my mind, including who are these activists? So in other words, can you describe their profile and how this may be changing?
Yeah, absolutely. So, the majority of the transactional activism that we're seeing is not from, traditional hedge fund activists, although, they are, of course, still in the mix, but really more so from, traditional, long-term institutional investors, as well as private equity firms. It's often their first activist campaign, and they will sort of go to great lengths to say so, but that they simply could not, not speak out. Having said that, we are seeing, some of those players get more comfortable with the approach, and we're seeing them pop up on multiple campaigns. Another trend that we're seeing is that there are multiple activists, in a single contest. Sometimes two or three. In the Ricci Brothers situation, there were six activists that publicly came out against the deal. Of course, these shareholders may be working in isolation, or they may be working, they may be encouraging others to come out publicly to increase momentum for the campaign. The last thing I would say is, I think it's worth noting that, institutional investors and private equity firms, that may come to the rescue of a struggling company with a cash injection, potentially, using a PIPE transaction that affords them, nomination rights or other special rights. Place that shareholder pretty well to potentially undertake, activism down the road, if there's, eventually some misalignment. So, that friendly cash injection today can potentially lead to some activism, down the road.
Thanks, Bill, for that input on sort of the traditional activists. I'm thinking now on the passive side. Tom, once an activist challenges, or maybe I should say proposes a transaction, what reaction do you see from other shareholders?
So definitely there's reactions from your traditional institutional investors, such as your pension funds, your insurance companies, mutual fund, index funds, and exchange traded funds, especially if they're reluctant to start their own activist campaign. We've seen, as Bill indicated, that they're often quite willing to speak with and potentially back an activist. And part of the reason for that is that those traditional institutional investors, they're long-term investors, often with limited ability to exit their investments. And so at the extreme, an index fund, for example, will keep its investments in the company for as long as a particular fund or a particular company happens to be in the relevant index. So that limited ability to exit provides an incentive to support an activist campaign that will increase shareholder value. And a significant percentage of many public companies are held by a relatively few number of traditional institutional investors. And because of that, the support of those traditional institutional investors, particularly those index funds, can be decisive to the success or failure of an activist campaign.
Thanks, Tom. And Jason, we often see arbitrageurs jump into the stock immediately following deal announcement, and they can often have a significant influence on the vote to approve the M&A transaction. Can you talk to us a little bit about how arbitrageurs may act or even respond to a transaction, and perhaps the implications for the shareholder vote, particularly in the context of a contested M&A meeting?
Sure. I don't always think of the arbitrageurs as really activists, but they certainly can impact a transaction. They really are in it for, I would say, a quick buck. They want to make a bet as to whether they think the transaction may or may not close. There's usually a little bit of a spread once a deal gets announced. The market will react itself, whether it thinks what's the likelihood of the deal closing, what's the timing to closing. And then there's usually a spread. The closer you get to sometimes if the market thinks there's going to be competing bids, it may actually jump over the offer price. But in a deal that the market thinks is going to close, if the offer is $40, it may start to settle in the $38, $39. And the arbitrageurs just try to make their money on that $1 to $2 spread. They're generally not interested in being long-term shareholders, so they're a bit different than some of these activists who may actually like the company but not like the deal. The arbitrageurs really just like to make the quick return. Their strategies can be different if it's a cash deal versus a share deal. So in a cash deal, they're really trying to make money on that small spread between what the shares are trading at and what the offer price is. In a share deal, they may get a little more creative. They may buy shares of the target and short shares of the buyer, so they can play the market a little better. In terms of what's important to them, information's key, right? Anyone that wants to invest in stocks, the more you know, the better you can invest. And so our arbitrageurs will often reach out to management at the company and ask them really what they want to know is about deal certainty and timing. So we'll often get questions about where you at in the regulatory approvals, has the antitrust approvals been obtained? Really what they're trying to say is what's our time value of money here and what's our likelihood of closing? In some cases, but not too many, you may actually see the arbitrageurs try to push the price. So they'll play a little game of chicken with management, and especially in contested hearings or transactions where they think their vote may be the differentiator. They'll say, look, we'll sign a voting agreement, or even if we don't sign an agreement, we'll agree to vote in favor, but we want you to increase it, a quarter, $1, 50 cents, whatever the right number is. They need to be a little bit careful because at the end of the day, management and the parties to the deal know the arbitrageurs don't really want to get stuck in a deal that gets voted down. So I think it's a little bit a game of chicken. And so, if I was advising an issuer, it really is case by case. If you really think you need those votes and that's going to make a difference, then maybe you do something with the arbitrageurs. But for the most part, I think buyers and the targets just want to make it clear there's no more money in the kitty. So, you just sign up to this deal or you're going to be stuck as a long-term investor.
Thanks, Jason. Now that we've got a sense as to who may get involved in challenging a transaction, let's talk about tools or strategies that activists may use. Jessica, can you tell us about the legal framework in Canada that applies to activists and why many consider Canada sort of an activist-friendly environment?
Yeah, thanks, Aura. There certainly are tools that are available in Canada for activists to leverage. For one, anonymous stake building is possible to a greater degree than in other jurisdictions. In Canada, activists can acquire up to 9.9 of the voting shares of an issuer before hitting up against any sort of insider or early warning disclosure requirements, whereas in the US and the UK, for example, the threshold is lower, closer to 5%. For another thing, in Canada, shareholders holding a relatively small voting stake, 5% or more of the outstanding voting shares, can requisition shareholder meetings themselves, including to contest fundamental transactions or replace directors. There's also exemptions from our proxy solicitation rules that are only available to activists. The first of which allows them to solicit proxies from up to 15 shareholders without an obligation to send a proxy circular. And similarly, as Bill mentioned, the public broadcast exemption also permits solicitation by an activist without a full-blown circular. So both of these exemptions give activists flexibility that the target company doesn't have in terms of communicating with shareholders quickly and at a lower cost and potentially at a lower effort as well. Another important tool is Canada's statutory oppression remedy claim, which is available to shareholders seeking relief from actions or omissions, including potentially proposed transactions of the company that are oppressive, unfairly prejudicial, and that unfairly disregard shareholders' interests. And this is a powerful tool because if successful, the courts have a broad authority to make a variety of remedial orders, including setting aside the transaction altogether.
Thanks.
Finally,
Go ahead.
Sorry, I'll just mention this last piece. Dissent rights are an important feature as well of the legal landscape in Canada. This is another statutory right available to shareholders, which allows them to object to fundamental changes, including certain M&A transactions, and to be paid fair value for their shares as determined by a court. There are other levers that Bill and others have mentioned that activists can pull in the context of maybe a traditional board fight, but I would say that these are some of the main tools that are available to dissidents engaging in transactional activism specifically.
Thanks, Jessica. Definitely important point to highlight on the dissent front. Jason, can you talk about some of the strategies or actions that activists may take when challenging a transaction?
Sure. And first, I think it's important to understand, or at least for targets to understand, that the activists, before they even approach the company, will have done a fair bit of work. They may have engaged, one or more sets of lawyers. They may have engaged proxy solicitor firms. They may have engaged a financial advisor. They may have already spoken with other shareholders. So when a target company realizes an activist is there, I mean, it's much like a hostile M&A deal. You can be playing a fair bit of catch up, maybe a little less so if you've announced a deal, because you obviously as a target know what the deal is. But there is a bit of readiness on the part of the target that would be important. But in terms of what the activist can do, it depends a little bit whether they're proposing their own transaction or they're opposing a transaction. And how aggressive they'll be. In either case, you often see a friendly, or at least what they want to be perceived as a somewhat friendly approach to reaching out to maybe the IR person or someone at the company with we'd like to talk about the deal. They don't necessarily say we hate it or it's terrible, but they start out and you don't know if it's going to be positive or negative. It can become pretty clear pretty quickly on that first call where they're going, although sometimes it can still be a fairly gentle, friendly call that they just want more information. Either as the initial approach or following that, if they don't get what they want, they can become a little more aggressive. A sort of bear hug type letter may be sent where they say, look, we want you to do X and Y, or if you don't, we're going to take this public and everybody else will see how bad the deal is or what it is we're proposing. In other cases, the activist may not give any warning. They may not ask for a friendly call, or they may ask for a friendly call but no bear hug and just go public and trying to catch the company off guard. I don't know that we were caught off guard, but in the Magnet deal, there was an initial call, and we didn't necessarily think anything else was happening. And then either the same day or the next day, Nalor issued a press release with some of its the issues it had in the transaction. So I guess part of it's to catch the company off guard. The other thing that they may do is they may acquire shares. That gives them either A, increased voting when they want to vote on the transaction, or B, if the transaction does go ahead, but at an increased price, they can make a little profit on that. In the Magnet and other deals I've done, I've seen lots of these steps taken by companies, like I said, where they issue a press release, they put sometimes all kinds of hyperbole in it. It can vary what they do, and then finally, in terms of challenges, there are other legal means that I've seen on many deals. They can complain before courts. They can complain to the TSX. They can complain to the OSC. Or bring other actions, either complaining about the process that the company took, complaining about something that the buyer did that was wrong, or maybe inaccurate or incomplete disclosure. One thing that was a little surprising in Magnet was that the dissident not only came to the interim order, but actually raised some challenges at the interim order. What you more commonly see in a deal that I did in 2022, the dissident came to the interim order, but said, we're not making any challenges. We just want ourselves known. And if we have any challenges, we'll bring it in the final order. That's the more typical route, because the interim order is usually fairly procedural. But we did see some I don't know, I thought some novel type challenges in Magnet, none of which frankly were successful, but were creative anyways on the part of their lawyers, I guess. And then last, you can see challenges before the OSC, often on things like 610101 issues. If the target has said there is a 61-101 matter and there's a minority vote, maybe they'll challenge who, maybe others should be included or excluded from the vote as part of the insider group. Or if there isn't one, they may say there should be one. So that's some of the different strategies that we see.
That's interesting, Jason. And I guess from the other side of it, Bill, what are you seeing in particular when Laurel Hill gets engaged by an activist? Are there any other strategies that are considered?
Yeah, I mean, I think there's a few things. So, certainly at one end of the spectrum, you have, some shareholders who may not see the need or may simply be unwilling to, fight an aggressive public campaign, but they'll still put out a press release. They'll potentially take that a step further, and as Jessica made reference to, utilize the private solicitation exemption to talk to up to 15 other shareholders, and of course they can use the public broadcast solicitation as well. But I would say some of the strategies are getting more aggressive. In Ritchie Brothers and in Magnet, for example, the dissidents in fact called on shareholders to vote against using their own proxy. So they put out their own circular and their own proxy. To our knowledge, those are the first two examples in Canada of a dissident actually soliciting on their own proxy against an M&A. Another strategy that we've been involved with, in recent years is activist tender offers to acquire up to 20% of the company. It's at premium to the deal price, and it's set to expire before the record date for the deal vote. So, effectively, these are designed to, to help the activists build a greater stake in the vote, so that they can block the deal vote. They're not formal 62-104 takeover bids, so they're not subject to the same requirements. They can be open for just a few weeks. There's not necessarily a minimum tender condition, and they've been used with some success. We did see these used in the Transat Air Canada proposed deal, in the in the Hudson's Bay company take private, as well as in the SIR Royalty Income Fund proposed deal.
Thanks, Bill. I think it would be helpful now to turn to some of the steps that companies can preemptively take to minimize the risk of being targeted by an activist, or being ready if and when targeted. Tom, can you discuss any corporate governance or other steps that can be taken?
Sure, Aura. Well, I guess it's really easy to minimize the risk of being targeted by an activist if you have consistently strong financial performance. But of course, that's much easier said than done. So companies should also consider the following steps. First one I would suggest is implementing advance notice provisions in their bylaws, which can help give at least a heads up about activist campaigns. Also, I think it's important to regularly review the company's business plan, strategic alternatives, and intrinsic or standalone value. and that will include regular updates of financial projections. I'd also suggest thinking like an activist. And by that, I mean thinking about how an activist would criticize the company and what an activist would request. As Bill mentioned earlier, activists are really looking for untapped value, and that value can come from returning cash to shareholders through dividends or stock repurchases, or proposing opposing transactions, or proposing alternative transactions, divestitures, spinoffs, things like that. So think about what an activist might focus on as the source of untapped value and prepare accordingly. It's also crucial to maintain a dialogue and relationship with your shareholders. As we discussed earlier, many traditional institutional shareholders want to talk about and focus on long-term and current value, and they're going to want to have a meaningful engagement with management. It also helps in those conversations to articulate why the company's current plan is value maximizing, and one should consider also having a frank conversation as to why potential alternatives are not value maximizing. As I mentioned earlier, the support of those traditional institutional investors can be decisive in an activist campaign, and an activist is going to have difficulty succeeding in its campaign if the company has already established credibility and support from its institutional investors. Index funds are definitely more likely to support a company that has demonstrated that openness to engagement. Finally, I'll say that the company should have good corporate governance. Activists frequently will couple their economic thesis with environmental, social, and governance arguments that attract the support of some of the institutional investors. So if a company already has a good track record of ESG, then the activist is left without one of its powerful enticements. Also, good governance helps build investors' confidence in the company. And on the flip side, poor governance can be a fuel for an activist campaign.
Thanks. And Jason, you referenced your recent involvement in the Magnet transaction. What were some of the things the Magnet special committee considered or did to try to prevent any activist steps?
So I mean, they did a few things. I mean, one is actually striking a special committee. That's one of the first things that you think about in a deal. Is it the type of deal that a special committee is required? Is it one, even if not required, that it's desirable? Clearly, since we were on for the special committee, it was a pretty easy decision, frankly, in Magnet. They really needed one. Special committee then can engage its own counsel. Special committee can engage its own financial advisor and make sure that it's got at least one financial advisor whose fees, and this is a bit different than in the US where I think they don't care as much about this, but in Canada, make sure that one of the financial advisors' fees aren't success-based. You can engage proxy solicitor firms, early on, even before announcement, to help you with what might in shareholders and others care about when the deal gets announced. You can speak to others. You can speak to third-party shareholders to see if they like the deal ahead of time. That's always a tricky one. You want to get, as many shareholders signing voting agreements, but you also don't want to broaden the tent of who knows about a deal before it goes public. So you don't usually go out too broadly to your shareholders, other than sort of maybe very large 10+ percenters, and then of course the insiders like directors and officers. The other thing you can do is which we did in Magnet in most deals, is either run an auction or at least a market check. So that way, one, you are more comfortable that the deal that you're supporting is in fact the best deal, and two, if someone then challenges it, one of the things they'll challenge is that, hey, you didn't run a process. How do you even know that deal's good? Or even if you run a process like we did, they may well challenge the process just because they'll challenge everything you do. But running a good market check is important. And then the last thing that you can do, but I always sort of caution this one, is you can preemptively, if you have questions that are on the line, go to the TSX or go to the OSC ahead of time. But I'm always a little bit loath to go to the regulators. I prefer to come to a conclusion or decision and run with it. And if they ask us, then react that way. But certainly I have been involved in deals where we do go to the regulator ahead of time to sort of pre-clear something that's could be argued either way.
Thanks, Jason. I think that's a good point, just being careful with that one on the regulators. I'd like to now switch to the next item on our agenda, which is defensive strategies available to targets once targeted. As we all know, despite the best planning and intentions, no company is fully immune to activist challenges. Bill, can you discuss, based on your recent experience, what some of the strategies are that you've seen issuers use to deal with activists?
Yeah, thanks. So I'll touch on three key areas. I think for starters, and probably goes without saying, but you have to take the activist seriously, but don't let them draw you off course. And so, if they blindside you with a public statement, try to keep the lines of communication open, offer to engage, offer to hear them out. If you can't address their concerns and they're clearly gearing up for a fight, you don't necessarily have to fight on their terms. So stick to your key messaging, avoid the temptation to sort of rebut them line by line. You should also try to avoid getting overly personal. If the deal does fall apart, you may be stuck with a very with a sizable, unhappy, disgruntled shareholder that you have to deal with. Secondly, I would say you really have to get in front of your top shareholders urgently, and tell your story. For my legal friends here, I would be remiss if I didn't say, be very careful if this is before your proxy circular is out, not to trip over any proxy solicitation rules. But talk to them about, the why of the deal, the why now, and, what the process was that you followed, the integrity of that process. Do not assume support, listen very closely. And really you want to get a sense of, how they feel about the deal and, whether or not the activist messages is resonating with them or not. And so, the third thing I would say is, talked earlier about, multiple activists coming out. Well, you can also have, other supportive shareholders come out for you. So if significant shareholders love the deal and they're concerned that, the activist campaign may derail that, ask them to put out a public statement of support. In Ritchie Brothers, as I said, 6 shareholders came out against it, but 4 shareholders came out in favor of it. And so, certainly that's an option. You could also ask them to privately communicate their support to ISS and Glass Lewis if they're subscribers to help, influence positive vote recommendations. And I know we're going to talk a little bit more about the proxy advisors later on, but that's certainly, another option for you.
Thanks, Bill. Really also sounds like activists want to engage and certainly want to engage quickly. Jessica, who are the players that may get involved in a proxy fight?
Yeah, thanks, Sora. We talked about this a little bit, but it's a great point to zero in on. Just to echo some of the earlier comments made, good advice for boards and management is to be proactive, and as Tom said, to think like an activist and how you can avoid becoming targeted by maintaining, an objective view of the transaction, of your strategy, plans, and potential alternatives, and also anticipating potential vulnerabilities, whether that's specific to the transaction or more generally with respect to your company's strategic direction or existing asset performance. This is an exercise that really calls for strategic advice from a variety of advisors. And so companies, I think, should be ready and have an integrated sort of defense team, which would be made up of external legal and financial advisors, shareholder communications firms like Laurel Hill, public relations and communications specialists. And that team should be integrated with the company's own IR, PR teams with senior management and board members. So I would say a key takeaway for management is to put some thought into your defense team in the quiet time and those advisors you want to have on your speed dial, because it becomes really important to your defensive strategy that you can quickly mobilize them. It becomes critical, frankly, to your ability to respond effectively to an activist when the time comes.
Thanks, Jess. Definitely a team effort and a lot of work that's involved. Jason, can you discuss the strategies you've seen on the legal front?
Sure. There's a lot of different strategies, and again, it depends a little bit on the nature of what the activist campaign is. So if it's an activist challenging a transaction you've already announced, you may take a different tack than if it's an activist proposing its own transaction that the company may not think is in the best interest of the company or the shareholders. So, I mean, one thing the issuer can decide early or throughout the process, frankly, is do they go on the offensive and really challenge or attack the dissident and the dissident's credentials. I would say most often you don't see this, even though it feels like it would be more fun and creative. And I think in the early days, I remember being involved in some contests years ago that got fairly nasty. I think the general advice, and I think Bill already mentioned this, but the general advice is to stay sort of professional and focus on the matter at hand as opposed to the person. I mean, the only time I would say that it really makes sense to challenge the activist is when they're proposing a transaction that the company may truly believe is opportunistic or just at a bad timing. The company's share price is down, or they're really their interests aren't aligned with the company. Then you may want to come out and explain why they're being opportunistic, and certainly if they have a history of being opportunistic and trying to make a few dollars for themselves at the downside of everyone else, you may challenge it. Otherwise, you sort of stay away from the street alley type fight. I know in Magnet there was discussions, and some of us thought it might be more fun to try to challenge the credential of the dissident and to take pot shots, but it was really determined that that's just not the right way to do it. You frankly lose probably some shareholder support when you do that. So the moment of feeling good for 1 minute and calling the other side a bad name is not a successful strategy in the end. The other thing you talk about is how much do you refute, and this is a bit of a challenge. You get a dissident with a press release or a circular, but some form of disclosure, and they say a lot of things that you think are just wrong or embellishments or misleading. And how much of a line by line refutation do you do? Do you go through each one? And I think what the general advice is that any press is good press for the dissident. They just want noise. The more noise there is around your transaction, the more it seems uncertain, more it seems there's doubt. So even though it seems counterintuitive, if you have good answers to every one of their challenges, you're often better off not to go by every item. Some of the ones that are just really egregious, or you just think your shareholders are going to read right through because they don't make sense, you leave alone, or just generically in your response by press release may say that without getting into some of the hyperbole, and then maybe you refute, if they're saying that the deal's not really at the value it should be, you may want to explain why that's not correct. So you'll answer that. Then I'd say many of the challenges we sort of referred to before that a dissident can make are really available for the company. So the company can challenge the disclosure that the dissidents made, either via press release or in its own circular. They can challenge it just publicly and try to call it out so its shareholders can read that that this disclosure is no good. You could go to a court. You can go to the OSC. I've seen certainly clients that we've gone to OSC before and say that they're making unsubstantiated claims. You should reprimand them. You should, the ultimate goal is to have them have to make corrective statements so that shareholders then see them saying what we said was wrong. So that that's one thing. You like I said, you can go to courts. You could bring your own litigation. I've seen that happen before. Another thing you can do is challenge whether they're part of a group, because in almost all cases the dissident will have spoken to other shareholders. I was on for a very passive investor a couple of years ago that didn't like a deal. There was a fairly aggressive activist involved who would reach out to them, and our client had just said, we agree with a lot of what you said. We're really not activists. We don't want to get too involved, but we certainly agree. And if the deal goes ahead as proposed, we're going to probably vote against it. And company counsel sort of, was told that our client was maybe going to vote against it, and wrote very aggressive letters to our client, how you're now part of a group, you're going to be attributed all their shares. And I told our client that they really weren't part of a group. We hadn't done anything to be, but they were just the notion of being part of a group was enough to scare. I don't think it would scare the leading activists, but the passive activists, the ones that Tom had talked about earlier, a lot of them don't want to be seen as getting down in the dirt, and it really scared our client away, and sort of agreed to a bit of a settlement when I didn't think it was necessary, but they just didn't want to be part of it. So that's another thing that I mean, I felt like I was on the wrong side of it, but it's something that's open, to use as a way of challenging.
Right, any obligations that may potentially be on them on a go-forward basis if they're considered acting jointly in any way.
Exactly.
Thanks, Jason. On to our last topic. I'd like to talk about how the two key proxy advisory firms, namely ISS and Glass Lewis, play into contested M&A deals. So as many of us know, for better or worse, the recommendations of these firms can have a significant outcome on the result of a transaction. Bill, can you speak to the factors ISS and Glass Lewis consider in formulating their vote recommendations?
Sure. Yeah. So, our clients are often surprised to in fact learn that ISS and Glass Lewis, who may cause them a lot of anxiety around their AGM, also make voting recommendations related to M&A transactions, or that they have a formal policy framework for doing so. The fact is we're actually seeing, more vote recommendations side with the activist. Sometimes split between ISS and Glass Lewis, as in the Ritchie Brothers and Magnet cases, but also in the case of Tech, they both came out, against the transaction. So their review and analysis is really centered around a number of key considerations. They're going to look at the strategic rationale for the deal. They're going to look at the process. They're going to look for any conflicts of interest. They're going to look at obviously the premium, the valuation, the market reaction, and certainly in the case of share exchanges, they're going to look at the governance profile of the resulting issuer. I think as you develop your deal announcement and you develop your proxy circular, you certainly have to think about those considerations and make sure that you're addressing them adequately, sufficiently. So the other thing that's important to know is obviously depending on your shareholder composition, the proxy advisors are going to have more or less influence on the vote. So obviously, if you're highly institutional, it can make or break the vote. If you're more heavily retail, it won't have a direct bearing. But as we all know, those recommendations are going to be leveraged through press releases for both institutional and retail audiences. So at the end of the day, it often doesn't, it often doesn't matter, even if you have a low retail or rather a high retail ownership. We still certainly spend a lot of time with our clients preparing them for the ISS recommendations and engagement calls, et cetera.
Thanks, Bill. I think that's a really good point. So many of my clients say, well, we don't have a large institutional shareholder base, therefore we don't necessarily need to worry about the recommendations of Glass Lewis and ISS. Jessica, when you say in your experience, what can issuers do to try to sway ISS and Glass Lewis? Can we have meetings ahead of the shareholders meeting with these proxy advisory firms? Any suggestions on that front?
Yeah, certainly. Before I get into that, I'll just say I completely agree with Bill's comments regarding the influence of these firms and their recommendations. And it's really important to keep in mind that it goes sort of well beyond the institutional shareholders, as you said. In my personal experience, I was dealing with an issuer that did have a fairly high retail shareholder base, but the fact that these recommendations become publicized, broadcast, commented upon by both sides of the transaction, and furthermore by the media, it becomes a really important factor in the lead up to the vote. So yeah, like a key thing to consider here is that the advisory firms have a really good grasp of your transaction, and they'll get a lot of that from the disclosure materials that are publicly available. But you can also get a meeting. And if you can get one, it's a really good proactive step to get in front of them and to be prepared for that meeting. You'll want to show up and really clearly knock off those points in sort of their policy. So you want to present the benefits and merits of your transaction. making sure that they understand the strategic rationale, that they have a good grasp of the terms, the premium, the structure, whether or not there are any difficult closing conditions to be satisfied, or the absence of those sort of closing conditions is helpful. Demonstrating the market reaction and giving them some further color on that is very helpful. To build comments as well, and other comments that we've heard, you'll want to demonstrate to them that you followed a really robust process. In other words, you want to explain to them some of the details of your strategic review, run through how you've managed or avoided any conflicts of interest, really hammer home that you've engaged in a rigorous negotiation and have arrived at, truly arm's length terms. And if you've got one or more fairness opinions, including a non-contingency fee-based fairness opinion, that's also a helpful thing to highlight in those meetings. And then lastly, we've heard this a lot throughout discussion today, but really you want to be prepared to respond to the challenges that the firms may have heard from the activists, but also anticipate what those challenges might be and know really well what the vulnerabilities are. And in the context of a contested transaction, whether that's around expected synergies, you really want to backstop any analysis that you have on that. To the extent that you're vulnerable to execution risk for any number of factors, regulatory risk, these are things that you'll want to think about in advance and come prepared to address in that meeting.
Thanks, Jessica. It's also interesting to hear some of the discussions behind the scenes as to when you want that shareholders meeting. If you're on for the company, do you want to be first? Do you want to be after the dissident meeting with some of these proxy advisory firms? Jason, anything you wanted to perhaps add from the recent Magnet deal or other transactions you've been involved with?
Yeah, there's not really too much. I mean, I can reiterate again how much, fortunate or unfortunate ISS and Glass Lewis really can have a lot of sway on the vote. And I think, they sometimes seem to get it right. They often don't. It's really frustrating that, they will sometimes take, I think ISS more commonly does at least have meetings with the issuer, so you can at least give your side. In a few deals I've done, Glass Lewis didn't give the issuer the benefit. Even in the Magnet deal where Glass Lewis voted against our deal or recommended voting against our deal, they didn't provide the issuer with an opportunity to meet with them, which is pretty frustrating because, I don't think they got it all right in their report. So I would just say, acquirers and issuers really agonize waiting for these results, not because they necessarily want to be, learn about the good reading that they get from the ISS reports, but it just really makes a big difference on the deal. If you do or don't get it can really sway the vote. Issuers should really get themselves ready and not, this is not a meeting you want to just wing. If you've got an ISS meeting, you want to be well prepared for it. You want to work with your lawyers and your proxy firms who have been through this many times before and anticipate what are they going to ask, what are the key points, and come across as well as you can. And then, I don't know if it's ironic or funny, but issuers will often have two press releases sort of ready to go. One saying, how glorious and smart ISS is because they voted in favor, and the other one saying how it's crazy that ISS voted against the deal. And you have those press releases kind of on the ready. And even where ISS votes against a deal, they'll usually have at least something about the deal that's good. So even when you get the vote against, there's a press release that says how disappointed we are, but we are pleased to see that ISS recognized that we did X and Y. And even ISS has, you can only carry it so far because if they vote against, they vote against. But you do try to pick at least one or two nuggets, even in the negative press release. And that's what we, in Magnet, we the press release said how great ISS was, and in the Glass Lewis, they voted against, but we still picked where they sort of, where they got things wrong and where they got things right. Of course, the parts that were in our favor.
Thanks, Jason. That's certainly reflective of my experiences as well. I'm just looking in the questions panel, and it doesn't appear that we have any questions from anyone who may be on the line. So I really wanted to thank everyone on our panel for this very informative and interesting discussion. And given that we do have a few minutes, perhaps before we sign off, can I ask each one of our speakers to maybe give us their key takeaways? Bill, do you mind if I start off with you?
Yeah, of course. I'll just say something that's, I would say is quite central to, the type of work that we do, and that's shareholder engagement. Obviously you need to know your shareholders, and you need to have a relationship with your shareholders, and always have sort of the pulse, and understand, what their concerns are and what their priorities are. Certainly, obviously, as I mentioned, if you announce a deal, you need to really get in front of them as soon as possible and tell the story. After your AGM, you need to identify where negative votes might have come from for directors or say on pay or any other special resolutions. And get in front of those shareholders and try to understand, their concerns, and perhaps, reinforce, your approach to those things. And, if nothing else, the lines of communication are open, and just sort of, specifically around that, make sure that you're talking to the right people. Not, the portfolio manager obviously is important, but there are often governance people that are not known to the to management, that are effectively the ones that are making voting decisions. So it's important to get an audience with both of those groups.
Jessica, anything on your end?
Yeah, I would just say that given how sophisticated activists are and the level of preparedness that they bring in their challenges, is that you really do want to be ready with your defense team for when they come. So don't get lulled into a sense of complacency, or think that, internally this could be something that could be dealt with purely by management or IR. These are sophisticated actors, and you want to meet them with your full bench of lawyers, financial advisors, shareholder advisory firms, communication specialists. Just be ready with those people on your speed dial.
Ready with your defense team. Tom, what about you?
Yeah, I have a few. I'll say responding quickly and professionally to activists is important. You should listen and consider their proposals and try to collaborate with the goal of hopefully resolving it, and certainly to avoid going public and airing this all out in a public forum. I'd also say that it's important to update your internal financial projections regularly based on reasonable assumptions to know your company's standalone value. So when someone comes knocking about a potential alternative transaction or a potential course of action, if that makes sense economically, or whether it's just not value maximizing for the company.
And Jason, any final takeaways?
Yeah, so I mean, it's a little overlap with some of the others, but I just think issuers should be prepared, and I know that issuers are busy running their business, and no one loves spending money on lawyers when they think they may not need them, and I certainly have a lot of issuers who are kind of the view, well, I don't want to spend the money and I'll deal with it if and when it happens, and we may never be the target of a hostile action or a proxy contest, so why don't? But I just think it's the wrong approach. I really think it's worth having issuers having their law firm come before their board and present to management and the board just at a high level, like just so that they're prepared and understand how does a hostile deal work, what are the things you can do ahead of time, some of the things that were already discussed. And for any issuers on watching this webinar, I would say, well, I can't guarantee others would say this. I know with clients, I most lawyers are keen to get in front of their clients' boards. And so most lawyers would be happy to do the board presentation and not charge for their time. I can't guarantee that's true for everyone, but maybe they charge a little bit to prepare the presentation, but the actual time before the board, most lawyers like that. So I certainly am always happy to present before a board, and if cost is a factor, I certainly don't care if I charge for that presentation. I think it's important for the issuers, and it's good for everyone that may ultimately be involved. So be prepared. If you're the subject of a hostile bid or a proxy contest, life's going to get hectic and chaotic, but at least if you know what you're doing going in, it's a little better. I've seen it on both ends. I've had clients who didn't prepare at all, and they just had no clue. They had no clue, and were then doing the learning, and losing valuable time and days when we could be, better responding. And instead, we're kind of explaining how takeover bid rules work, and it would have been better had that been done a month, a year, whatever ahead of time.
Thank you for those great takeaways, and I wanted to thank everyone for attending today's session.